We continue into chapter 3 of life insurance taxation. And then chapter 3 and chapter 4, those are the two remaining chapters. And these chapters are not overwhelming, so we should be able to go through them very quickly. Okay, this chapter looks into the taxation condition, okay, of life and disability insurance products, including annuities and segregated funds within Canada, in terms of death benefit, in terms of named beneficiary, in terms of premiums, in terms of adjusted cost basis, in terms of life insurance policy disposition, in terms of exempt and not exempt policies, and also policy loans. Corporate ownership of life and disability insurance, policy dividends, and specifics of annuities and segregated funds. So these, you see, are the various taxations of life insurance that we are going to be diving into right about now. So let's talk about each of them. Death benefit, that is our first stop. Well, life insurance benefits are tax-free. We know that already, don't we? Of course we do. Life insurance benefits are completely tax-free. You can read these examples yourself as usual, okay? I'm just asking you guys to read so that at least let there be something that you can make reference to. Okay. Perhaps in the future I might consider reading through the examples for some of you that may not have your textbook with you in the time you are listening or watching the video. But for now, we're going to fly through that, okay? If there is a delay in payment to the beneficiary and the interest accrued, the interest, which is also payable to the beneficiary, is taxable, but the original death benefit is not taxable. What this is telling us is that, let's say the death benefit is $1 million, and the insurance company, for some reason, delayed in paying that death benefit. And let's say there was there was an interest of maybe about 5,000 on that 1 million. So instead of the beneficiary receiving 1 million, the beneficiary received 1 million plus 5,000. So that 5,000, which is the interest, will be taxed in the hand of the beneficiary. But the original death benefit is what? Tax-free. Okay. The beneficiary can choose to take the death benefit in a lump sum in the form of either a lump sum which ends the contract or an annuity that results in a new contract. All right. So the beneficiaries have different options to receive the death benefit. If there is a delay in the payment of the death benefit, any interest that accrues in a taxable, any interest that accrues is taxable in the hands of the beneficiary. I've explained this one. As the beneficiary of her husband's life insurance, Martha chose to take the death benefit as a life annuity rather than a lump sum. So she will be taxed on the interest portion of the annuity payment. Okay. Okay. So like if somebody receives that benefit, instead of taking it lump sum, and the person, annuity is a form of investment. And we're going to be looking into annuities in details under the segregated funds, okay?
Okay.
All right. Let's move on to named beneficiaries. Named beneficiaries, okay? Now, the owner of a life insurance policy can choose to designate anyone as a beneficiary, all right? Probate is the process of validating the will. Probate fees are charged by the court for undergoing the validation process. Probate fees varies by province, okay? Life insurance proceeds pays directly to a named beneficiary stays outside the estate and are not governed by the will. Okay, so let's keep going. Life insurance proceeds pays directly to a named beneficiary stays outside the estate and are not governed by the will and are therefore not subject to probate fees, such as the estate administrator tax. You see, that's one of the benefits of having a life insurance and naming your beneficiaries. Okay. Now, when the estate is named as the beneficiary, the proceeds will become a part of the deceased estate and be distributed according to the will. As such, the proceeds will be subject to probate fees because it's part of the deceased estate asset. For example, Michael had substantial debt when he died and few assets. The named beneficiary on his life insurance policy was his wife, Renata. The insurer paid her the benefit. Michael's creditor, which includes the Canada Revenue Agency, therefore had no claim on the paid amount. If Michael had named his estate as the beneficiary, then the insured amount would have been available to his creditors and subject to probate. Okay? So, in other words, that benefit, insurance, that benefit, okay, by the purpose of naming beneficiary is creditor protected. Okay? Mm-hmm. Now we move on to what? Premiums. So this one we just read is very clear, crystal clear, okay? And that is why we tell people always name your beneficiary. All right, premiums, depending on the type of insurance, the premiums paid may or may not be tax deductible. In the section that follows, we will discuss the taxation of premiums for each of the following types of policies: individual group life insurance, individual group health insurance, and individual group disability insurance. Now, for individual life insurance, proceeds are generally not tax deductibles. Okay? An exception is in a business context. If the insurance is required as a collateral for a loan, then the premiums may be deductible. The loan must be with a chartered bank, that is a registered loan bank, a trust company, or a credit union, and it must be documented. Only the lower amount of the actual premium that is attributed to the loan, the net cost of pure insurance, which is NCPI, can be deducted. For example, Jen bought a 10-year life insurance policy and pays her premiums monthly. She cannot deduct this premium from income for tax purposes. Okay? What this is telling us here is that when it comes to individual life insurance, the premiums that you pay is not tax deductible. You can't deduct it from your taxable income. Okay, and that is why even if you have life insurance, what you see when you file your taxes, remember there are you go to your accountant, right? Your child care is deducted. I think there used to be gym. I don't know if gym is still there. You know, there are some expenses that are tax deductibles. And if you're not sure of what that means, you can Google expenses that are tax deductible under the personal taxes for personal tax purposes. You're going to see, okay? But life insurance premium for individual life is not tax deductible. However, if you're taking a loan, okay, and the person you are taking there, and this loan is from a registered company like Trust or Chartered Bank, and it's requested that you have that insurance, and the loan is documented. At that point, your premium will be tax deductible. Okay, awesome. So that is explained. We'll move on to group life insurance. Now, what is the tax situation under group life insurance? But we'll use example to dive in this understanding. Saul, is it Saul? Okay, Saul, right? Yeah. Saul personally guarantees his business line of credit at the bank where he does businesses. His bank requires that he has life insurance equal to the line of credit with the benefit assigned to the bank. The term insurance issued to Saul has $1 million coverage. The loan amount Saul's business owed to the bank last year was about, I don't know why they keep putting this 00. I can't, they say it's in thousands or what? Anyways, given that the loan is for business purpose and from a financial institution, it can be 40%, which is calculated as this in bracket, of a lesser amount of the premium and NCPR as a business expenses. Proceeds are received tax-free, okay? This just went on to explain about the premiums we can deduct, like I mentioned earlier. All right. Let's move on to David. The proceeds are received tax-free provided employee pays the premium with after-tax cash. The employer pays the premium that are then reported as a taxable benefit to the employee. Okay, so now for this one, right, you're going to see a questions that will explain this situation, and then they'll ask you to show who pays the taxes. Just know that where the employee, in terms of group insurance, right, where the premium is tax deductible, okay, the benefit that is received will be taxed. Okay, but however, where the premium is not tax deductible, okay, 100%, but there are situations that the premium will be tax deductible legitimately, and that is what they've told us. However, it's not everything that will be tax deductible. So it will be net cost of pure insurance based on the calculation we're seeing here that will be tax deductible. Okay, and in that situation, the proceeds, okay, that is received, that is the death benefit received, will be tax-free. However, there are caveats to that, provided the employee pays the premium with after-tax dollars. You see that? If the premium is paid with after-tax dollars, yes, it's taxable. However, if the premium is tax deductible, then the benefit will be taxable. Okay? Then provided the employer pays the premium that are reported as a taxable benefit to the employee. I hope you guys are understanding. This is for a group life insurance. So let me explain it better for you guys again, so you have a better understanding. Okay? So you're working in your organization now, and you have group life insurance. Okay? And this group life insurance, let's say the coverage is 500,000. For me, like when I was in GE, I was entitled to 500,000. Okay? Now, GE have this with Sun Life insurance. All right? Now, GE pays the premium 100%. Let's say GE pays $20 every month on my behalf. Okay, now I will receive, if anything happens, my beneficiary will receive this 500,000 tax-free, provided I report this $20 on my tax return. That is what this is telling us. It says the proceeds are received tax-free, provided, number one, the employee pays the premium. If I'm the one that is paying the premium with my after-tax dollars, beneficiary receive tax-free. Okay? And if GE pays the premium, I reported this because 20 times 12, that is what that's 240, right? So if I report this 240 on my annual tax return as a benefit, as a taxable benefit, then my beneficiary will receive the benefit tax free. So just know that where the premium is tax deductible, then the benefit will likely have some tax element attached to it. Okay? So I'm not interested in whatever Quebec does. We have no major business with Quebec. So I'm going to just go over that. So let's look at group health insurance. Okay, we just talked about individual life and group life insurance now. How does tax calculations works with group health insurance? Are you guys following me? We've looked at individual life. And we know that we say that I'm taking my time. You see me going back and forth. I'm repeating. Okay. So you guys will get it. You likely get exam questions here. Okay. So individual life, many of us already, some of us have life insurance. Whatever premium you pay, you don't deduct it from your taxable income. Okay. And that is why the death benefits are tax-free. Okay, now there are circumstances that you can deduct at least the net cost of NCPI from your could be tax deductible, but that has to meet the condition that you are borrowing money and the lender requested that you must have life insurance, and that and that money you are borrowing is from a chartered company or a trust. Okay. Mm-hmm. Now, we also went further to explain group life insurance. The way group life insurance works is that it's two ways. There are some group life insurance that is the employee that pays the premium, and then there are some that the employer pays the premium. So if the employee pays the premium, that premium is employees after tax dollars. Right? And if employer pays it, the employee will have to report it on their taxes as a taxable benefit. Okay? And that's what makes the death benefit received to be what? Tax-free. Okay? Now we are looking at group health insurance. So again, don't confuse group health insurance with life insurance. No, group health insurance is different from group life insurance. Where am I, Seth? Okay, this is group health insurance. Group health insurance is the one we are talking about, your health and dental care that covers your medication, that coverage that makes you go to physio, chiropractor, medical prescriptions. Are you guys getting me? So that's the one I'm talking about. That is group health insurance. There's group life insurance and there is group health insurance. You get it? If you didn't get it, don't forget about it too. Rewind it again and again and again and make sure you get it. Okay? Yeah. So this one is group health insurance. Okay. Oh, eh?
Okay, no, I'm just reciting it on my.
Yeah. So for group health insurance, unlike group life premium, group health premiums such as medical plan and delta plan paid by the employer are tax deductible by the employer and not a taxable benefit to the employee. Yeah. Okay. So this one now is a tax deductible to the employer, is not taxable benefit to the employee. Okay. So you guys see the difference. You understand?
Yes.
I hope you guys get this. If you are playing it, I hope you get this. So for group life insurance. I'm explaining it again. We have group life insurance and we have group health insurance. Okay, for a group life insurance, where the company, the employer pays the premium. Okay, that premium is a taxable benefit to the employee. Okay, and where the employee pays the premium, the employee pays with their after-tax dollars. Okay, so in other words, your death benefit is going to be paid tax-free anyways. So why would you enjoy tax benefit for something that CRA is not going to benefit from it when you get your death benefit? It's as simple as that. Okay, now the group health plan, this is health. Okay, so this one, there's no benefit after the fact. There's nothing coming. You are sick, you go, you get treated. Nothing is going to be paid after the fact. That is why the one the employer pays is tax deductible to them. Okay, and then the one that the benefit that the employee received, they don't have to, is not a taxable benefit. They don't have to report it on their income taxes. All right. So this, I hope after this repetition, you guys would have gotten it. All right. So we move. You see me, I'm not even talking about Quebec. Whenever I see Quebec like this, I say, why are you here? Right? You guys did not allow us to use our license to practice in Quebec. They are making us to write their own exams. Why are you showing your head up in front of me? Anyways, I just say that to make you guys laugh a little bit. All right, let's move on to individual health insurance. Let's talk about that one. I just talked about group health insurance. The same way, you see, there are people that don't have a plan from work, like business owners or people that their work don't provide them health plan, right? So for these ones, they have to, like, private health plan premiums can be claimed as eligible medical expenses. So for this one now, you have to pay for your own health plan yourself. You want to go to have a health plan that you can use to cover prescription, to do physio, chiropractor, and all the yara yara. But the good news is that whatever premium you paid is eligible for medical expenses. Okay. For example, Karen's employer does not offer group health insurance coverage. Consequently, she arranged her own coverage online and she can claim the premium she pays as eligible medical expenses. You see, and you guys know that we do health and dental too, right? We do health and dental. Okay, so you can talk to people about it. Oh, do you have coverage from work? If you don't have, you can take one and it's tax deductible. Oh, by the way, I need to add health and dental to my slide when I talk to people about business that we do. Anyways, let's move to individual disability insurance. So now we are moving on to disability insurance. Okay, so you see how the way we are going. So we are just looking at three different types of life insurance, but we look at individual, we look at group. Look at individual, you look at group, right? We've looked at life, individual life, we've looked at group life, we've looked at individual health, we've looked at group health. So let's look at individual disability. Is there group disability? I talk there's also group disability. Interesting. But let me tell you guys something. Anytime you see the word disability, what should come in your mind should be income replacement. That is what it's all about. How do you manage when you are not able to work due to disability? This is what this is talking about. So an individual can take on disability insurance, and also groups, companies, employers also take group insurance for their employees. So, but now we're looking at individual one. The premiums, and as we're looking at individual one, remember, we're looking at the premiums paid. We're not talking about the coverage. We're looking at that money they used to pay the premium. What is the tax implication? You guys understood this thing and the way I'm explaining it. No matter how they ask this question in the exam, you just be waiting for them to land. And at this point, let me just make a quick recommendation. You see, when you are practicing your exam, or you are in the exam, or you are writing the certifications, or even the main exams, it's possible that you see a questions and you get excited because you feel this question is familiar. Oh boy, I know this one. Yes. But calm down. Don't jump into the answer. Read all the questions and read all the answers. As you're reading the questions, know the keywords you're seeing. And even when you read the first answer, second answer, you feel you got your answer. Finish reading all the options given to you for answers. And then you can choose the one you feel is the correct one. Don't make that mistake to rush. No, read all your questions, read all your answers. I just thought to drop that tip for you guys. I hope you come back to thank me later. Anyways, individual disability insurance speaks to income replacement. So the premium paid on private disability policies are not tax deductible. The benefits received are also not taxable. Okay? You see that? You see the trend, right? Anything that have benefits waiting later, salary will not let you get taxable benefits. So the premium you pay is not taxable for individual disability. However, your benefit is also not taxable. Sorry, premium is not tax deductible. So by now, when we say tax deductible, I believe you guys know what it means. Okay. And then the benefits. For example, Jonathan is a self-employed. He takes out an individual disability insurance policy. He cannot deduct the premiums from income for tax purposes, but any benefits he receives will be tax-free. Okay. Group disability insurance. So we've looked at individual premium paid towards disability. How about group disability insurance? You see, when somebody is sick from work, you will feel short-term disability, long-term disability. Oh, EI, do you know EI is one of those two? Right? Income replacement. Why? Because when you're on EI, you get income, but not 100%, but at least you get something. Right? And then for many of us, you must have heard of WCB, Work Compensation Board, right? Aha. So let's talk about this one real quick, guys. So group insurance contracts can include long-term disability benefits, short-term disability benefits, or long-term and short-term benefits, or both. So these are group disability plans. All right. Premiums may be paid by either the employee or employer. If the employee pays the premium, it is done with the employee's after-tax income. Sinking, yeah. So if employee pay is after tax, okay, it's employee after tax income. The benefits are received tax-free and not reported on the tax return. This is the most preferred and most common structure of long-term plans. If the employer pays the premium is tax deductible by the employer and not a taxable benefit to the employee. Mm. However, they wait for you. The benefit received are taxable in the hands of the employee. I told you guys, when they give you benefit on one hand, they'll collect it from the other hand. You see that our most common structure for short-term plans. You see that? So when you receive that, when the employer pays the premium, it's tax deductible to the business of the employer. And for you, you do not need to report it on your income taxes. But the benefit you will receive, you will report it. That one will be taxed. So again, you guys see the inverse relationship, the way, the taxable structure works. You see, when your premium is after tax dollars, your benefit is tax free. But when your premium is tax deductible, your benefit will be taxed. All right. Life insurance policy disposition. Let's talk about this one. All right, let's talk about life insurance policy disposition. Although life insurance policies are received tax-free, there are other transactions related to life insurance policies that can have tax consequences. Exactly. Okay. If you guys have been following us, from the beginning, where I think she was in, is this chapter, around chapter 6, 7, 8 or so, where we talk extensively on ACB, deemed dispositions, and all those stuff, then this word's disposition should be familiar to you by now. There are several transactions that that the Canada Revenue Agency (CRA) generally considers to be a disposition for tax purposes. Therefore, any gains in the following situation will be taxable. Number one, policy loan, partial withdrawal, surrenders, and transfers to another party. Note that the Income Tax Act provides for an exception such that transfers between spouses have no consequences, have no tax consequences. Okay? A taxable policy, a taxable policy gain is calculated as follows. Okay? Proceed of disposition or cash surrender value minus adjusted cost basis. You see, you guys remember this? Oh my goodness, I remember. I explained this one to you guys, and there was even a place I talked about the grandfather policy and how the calculation of the ACB is done. You guys need to go to that chapter. Okay? So I'm not going to like, take too much time on this. I dealt with this. I really did. Okay. I'm not in life insurance. So yeah, I remember. I remember taking my time to explain this. So yeah, for example, Sandra decided to surrender her policy. The policy has a cash surrender value of 500 and an adjusted cost basis of this. Sandra will therefore report a taxable income of this equal this minus this. Okay. All right. Let's talk about adjusted cost base. Adjusted cost base. Well, adjusted cost base for tax purposes, the adjusted cost base ACB is the cost of all life insurance policies. For example, is the total sum of all the premiums paid put together. For example, someone that has an annual premium of $5,000, and if that person pays that policy off in 30 years, so that would be 5,000 times 30. So for a straight line calculations, that person's adjusted cost basis will be 5,000 multiplied by 30. So the person's adjusted cost basis will be what? 150,000. So if the person have a cash surrender value of 200,000, so the policy gain will be 200,000 minus 150,000, which should be 50,000. Okay? So that would be the adjusted cost basis. Insurance companies would typically provide the ACB to the policyholder if required or requested. Very important for agents to know what affects the ACB and how to calculate ACB. How the ACB is calculated depends on when the policy was last acquired. Last acquired, did we trash this one, right? The rules regarding the ACB calculation changed in 1982, and the old rules still applies to policies that have been last acquired before the change. So therefore, the NCPI of the calculation of the was modified in 2017, and that new calculation tends to decrease the NCPI. NCPI stands for net cost of pure insurance. For policies last acquired after December 1 of 1982, the ACB is calculated as this: premium paid minus net cost of pure insurance. For grandfathered policies issued prior to December 1982, the entire premium is considered to be what? To be your ACP. Okay? All right, so we move on to exempt or non-exempt life insurance policies. Let's talk about this one. Permanent policies may be either exempt or non-exempt. Policies have no cash surrender value, and therefore the distinction between the exempt and non-exempt does not apply to term policies. The rule pertaining to exempt and non-exempt policies will change after 2015. Exempt. If a life insurance policy is exempt, the earnings on the cash value in the policy are not subject to calculation in the hands of the policyholder. Permanent life insurance policies acquired prior to December 1982 are always exempt. If the policy is sold, then the exemption no longer applies. Policies acquired after December 1982 are exempt if they are purchased for the sole purpose of providing insurance and not as a means of investment. Okay? So for this exempt, in our software, there's what we call exempt test. This thing is a button. Okay, so we just click and turn on that button, and that switch on, the exempt status of that particular policy. Excuse me. And every time we run illustration for people or we complete insurance application paperwork, we always switch on that mode. Okay. Now let's talk about a non-exempt status of a life insurance policy. A non-exempt policy is one that is last acquired after December 1, 1982, but fails to meet the Income Tax Act. Exemptions requirement for additional information on the go and read it. So if you need additional information, it is here. You click on that link to read more. Okay. Upon failing to meet the exemption requirement, earnings are taxable annually as regular income in the hands of the policyholder. On the policy's anniversary, the insurance company must conduct an exemption test. So this one now, what the insurance company does now is that, there's like a gatekeeper that protects policies from losing their exempt test status. Okay? Because if a policy loses that status, that policy is exposed to CRA, and that's why the CRA will now be taxing that policy every year based on the non-exempt status. Okay, but insurance company doesn't allow that. Okay, if a policy is growing so much and the insurance company feels that this policy, the way it's growing, is going to lose its exempt status, the insurance company will request the policyholder to withdraw some money in order to keep the policy in an exempt status. Recall from the previous sections that a policy is considered exempt if the sole purpose of the death benefit is strictly for insurance purposes and not as a means of investment. So tax rules are changing. Some changes came to effect in 2015 regarding exempt and non-exempt policies. And this flux has a great impact on life insurance policies. Term policies do not have cash surrender value, and as such, the distinction between exempt and not exempt does not apply to term policies. All right, we move on to universal. Okay, universal life policies. I love this one. Whenever I talk about universal life, I'm like, ooh, that's my thing. I love universal life. Anyways, let's talk about this one. You guys know we're going to talk about it, of course, right? Mhm. When the cash accumulations limit permitted by tax laws are exceeded due to investment growth, the insurer transfers the excess funds to a side account in order for the policy to remain exempt. Only the income earned in the side account will be taxable. So in universal life, so you remember, recall when I say that with the exempt test, if the policy is growing, there's what we call a side account that money can be transferred into. However, if the policyholder doesn't want the money to be transferred into the account, they can withdraw it. But again, if the withdrawal happens, that withdrawal might be taxed again. So this side account might be maybe a tax strategy, as it's only the growth in that side account that will be taxable. Okay, let's talk about policy loan. With policy loan, if an insurance policy has a cash surrender value, you see, because again, this is a tax strategy. So you guys listen very, very well, because some people maybe say, oh, why can't I take my money? Is my money is a cash value? Yes, your money is your cash value. You can take that. But what are the ways you can take that money such that you won't have to pay taxes? That's what we're talking about. If an insurance policy has a cash surrender value and the policyholder can borrow up to the full amount of the cash surrender value from the policy, this is known as a policy loan and can only be done if the policy allows policy loan. Okay, amount up to the adjusted cost basis can be borrowed tax-free. Amount borrowed in excess of the adjusted cost basis are taxable. And when the loan is repaid, the policyholder can claim a tax deductions up to the amount that was previously reported as income. For example, Mario needs money for a home renovation. His insurance agent tells him he can borrow up to this amount from his policy cash surrender value, but he will have to declare this amount as income because his adjusted cost basis is this amount. Mario borrows the money, and when he repays it the following year, he deducted that amount from his taxable income. This is pretty much straightforward, but let me give you a direct example that you can relate with. Okay? Now, going back to the example I gave earlier of someone whose annual premium is 5,000. Okay, so and this policy is said to be paid off after 30 years. So now this is year 10. Okay, year 10, this person will be paying 5,000. It means he has paid total of 50,000. Right? Now he has cash value in his plan of what? Let's say he has 80,000 in his account, right? So now this rule says that he can borrow up to 50,000 from this account and he won't have to pay any taxes. However, if he wants to take 80,000, then you have to pay tax on the 30,000. Okay. Mhm. The reason is because his adjusted cost basis is 50,000, which is the total premium he paid. All right. So let's talk about corporate ownership of life and disability insurance. Let's talk about that one. Corporations often purchase insurance on key executives and employees. Benefits received from these policies are tax-free. First, premiums are usually not deducted from income. If the employee dies, then the corporation receives the death benefit. What are the tax implications of a person buying back a corporate policy? What are the tax implications? Let's see what that means. If a corporation has life insurance on an employee and the corporation sells or gives the policy to the employee upon retirement, any policy gain will be taxable to the corporation. This applies only to permanent policies. Term policies have no cash surrender value and therefore there will never be an associated policy gain nor any taxable consequences. Expert advice should be sought when there is a taxable benefit to the employee. For example, when Yvette was hired by her employer 5 years ago, the company purchased a 10-year term policy on her life. The company merged with another and Yvette's position was redundant. As part of her severance package, the company assigned her the term policy and there is no gain for the company on the transfer of this term policy to Yvette. That is pretty much straightforward. Okay, tax strategy based on differential between corporate and personal tax rates. Let's talk about this one. In cases where the corporation is the beneficiary of the policy, if the insured dies and the corporation receives the policy, or it receives the benefit, corporations benefits corporations benefit from a lower tax than shareholders. Therefore, it is advantageous for the corporation rather than the shareholders to buy the life insurance policy. For example, death has a combined federal and provincial marginal tax rate of 49.5%. The corporation he and his wife own has a combined federal and provincial marginal tax rate of 15.5%. Beth is not an employee of the firm. The premiums paid on the life insurance policy on Beth will not be deductible, either by the corporation or by Beth. Consequently, there are savings by having the corporation with lower tax rates pay the premium. When Beth dies, the proceeds of the policy will flow through the company's capital dividends account, referred to as CDA, to the shareholders on a tax-free basis. For example, to pay this annual premium, the company will only have to access this of corporate profit, while Beth will have to be paid this out of company's profit to have the necessary after tax to pay the premium. That's pretty much straightforward, isn't it? All right, let's talk about capital dividend account. That is referred to as CDA account. Okay. The CDA account is where corporation receives and holds any tax-free amount, such as life insurance proceeds. Any amount in the CDA account can be paid out as a tax-free capital dividend to shareholders. It's as simple as that. Okay? And okay, let me just explain it to you guys. I wanted to hold back. You see, and that is why when we go to propose value to people like doctors, right? Doctors that owns their clinic, we can tell them, you can take a policy and let your business, your clinic take policy on yourself. Maybe take like a 5 million policy on yourself because the clinic is owned by you, is a family business, right? Mhm. And then maybe the wife of the doctor may be the shareholder, the children are the shareholder. So if this doctor take the policy, the clinic takes the policy on the doctor, then the clinic pays the premium. Therefore, if anything happens to the doctor, the death benefit of 5 million will be paid to the clinic CDA account. And from there, it will be distributed to the shareholders who are in turn the wife and the children tax-free. You get it? If you don't get it, I don't know what to say. Oh my God. Tax treatments of the benefit when the insured is an employee or shareholders or both. Corporations frequently pay disability and life insurance policy premium for the employee or shareholders. The shareholder or employer will be the policyholder and the beneficiary of both. Okay. Premiums paid by the corporations are tax deductible by the employer and a taxable benefit to the employee. We've seen this many times, don't we, guys? Now, not tax deductible by the employer are taxable to the what? To the shareholders. For example, Louise is employed as a financial controller for a corporation. She also owns 15% of the company's shares. Because of her ownership position, any premiums paid on her behalf are not deductibles and are added to her income as a taxable benefit. Consequently, she pays the premium on her life insurance policies directly. Okay? So we move on to what? Policy dividend. Policy dividend. What is policy dividend? Anyways, permanent whole life policies may pay dividend to policyholders. Note that policy dividends are not the same as corporate dividends. Of course, they are not. We saw this, I think, chapter, is it 1 or 2 or 3? We broke this down. You see, different types of whole life, participating whole life, non-participating whole life. You guys remember? Anyways, go through it, okay? Aha. So policy dividends are tax-free when used to offset premiums or paid up as a death benefit. So when policy dividends are paid out prior to death, they are taxable as income as they are considered to be proceeds of disposition. They are not entitled to the dividend tax credit as it is the case with capital dividends. If the amount of the dividend exceeds the adjusted cost basis, if any in any given year, then the excess will be treated as disposition of the policy gain and is taxable in the hands of the policyholder. Okay, this is straightforward. We move on to what? Annuities and segregated funds. I guess they just want to give us a sneak peek. A wide range of annuities are offered by insurance companies, such as the individual variable insurance contracts, that is IFIX. IFIX are also referred to as annuity contracts and hold segregated funds. The taxation of the following annuities are explained in the section below: non-registered annuity contracts, non-registered individual variable insurance contract, (IVICs), or registered annuity contracts. Okay, we're going to be looking at each of them. Number one are the what? Non-registered annuities contracts. Non-registered annuities contract. Let me take you back a little bit to our registered programs. So the registered programs, we have RESP is a registered program. RRSP is a registered program. TFSA is a registered program. RRIF is a registered program. Now the new one, first time home buyers plan, is a registered program. So I said all this to cast your mind back so that when you see a non-registered annuities contract, so you just know, okay, this one is a non-registered, okay? So it means you are not doing it through any government registered vehicles, okay? So that being said, and I know you get the drift now, non-registered annuities contract is taxable. First of all, we're going to have a better understanding of annuities when we get into section. They are not giving us a background of what annuity stands for, right? But don't worry, we're going to get a better and in-depth understanding of annuities when we get into cell which is where we are headed next weekend. However, they are taxed depending on the structure and the type of income being paid. Both segregated funds and annuities may be registered or non-registered. Non-registered annuities, a portion of the payment is received tax-free as a return of capital, and a portion is received as interest income and is thus taxable. Okay, so you look at this. This is like an investment, right? Whereby your capital is received. So your capital will not be taxed, okay? But the growth, the interest on it, which will be the portion that is going to be taxed, okay? Now, for registered annuities, all payments are fully taxable as a regular income, okay? Because registered annuities enjoys the benefit of tax deductible at the beginning. So at the back end, at the front end, that is on the contribution side. So on the receiving side, that is when they get taxed, just like RRSP, right? When you make your RRSP contributions, your contributions are tax deductible. But when you make withdrawal, your withdrawals are fully taxable. Okay, so that's the same thing that happens here for registered annuities. But if it's a non-reg annuities, right, because it is your after dollar investment, so your part of your withdrawal that constitutes your capital will not be taxed, but the growth or the interest income on it is taxable. Make sense? Mhm. So let's go on to accumulation annuities or guarantee interest annuities. Let's talk about that one. Um, okay, so for accumulation annuities or guaranteed interest annuities are savings products similar to guaranteed investment certificate, similar to GIC and term deposit offered by banks. Okay, they offer creditors protection and avoid probate when a beneficiary is named. Interest earned is taxable in the year received or accrued, even if not received. Okay, now let's talk about prescribed annuities. Prescribed annuities offer special tax advantage. The interest is taxable and return of capital is non-taxable. Okay, these portions are spread equally across all of the payments. Again, this is straightforward. I've explained this one. Okay, now with with non-prescribed annuities, the payments the holder receives will be more will be more interest, will be more of interest than principal in the early years of the term to maturity and less of interest than principal near the end of the term. Interesting. For two identical annuities, one qualifying as a prescribed and the other are not, then the total amount of interest reported over the life of the annuities will be identical. So what differs is that the holder of the prescribed annuity will report less taxable income in the early years and consequently pay less tax. For example, Lola has an inheritance of this amount and wants annual annuity payments of this of for 20 years. Annuity interest rates for that terms are currently 3.15%. Her agent tells her that the annual payments on a 20-year prescribed annuities with such a deposit will be about this amount, of which 800, not 800, this amount is taxable. So therefore, the interest that will accrue for the first year on a non-prescribed annuity would be this, multiply as calculated as this. It would drop to approximately this amount by the 11th year. Lola chose the prescribed annuity and understands that the taxable portion each year will be leveled as shown in the following graph. Had she chosen the alternative non-prescribed annuity, then the taxation portion in the first year will be this, declining each year after that. So therefore, Lola decided that it is to her advantage to pay less tax now. Okay. Again, like I said, we are going to see have a better and a deep breakdown and explanation of annuities when we get to segregated funds. Okay. Annual taxable interest from a prescribed annuity contract and non-prescribed annuity contract can be depicted in this graph below. Okay, so move on to structured settlement annuities. Structured settlement annuities. Let's talk about this one. What does this mean? A structured settlement annuity is an annuity purchased by a casual insurer as a settlement of a personal injury lawsuit. The lump sum is paid to the insurance company, who then issue a single premium annuity and makes the tax-free payment to the insured party. For example, Rudolph became a paraplegic after a vehicle ran a red light and hit him. The driver's insurer and Rudolph lawyer have agreed on a settlement. The casualty insurer will purchase the annuity that will be paid to Rudolph tax-free. Okay, so we move on to non-registered individual variable insurance contract, that is EV, holding a segregated funds. Okay, switching between segregated funds triggers a disposition which can create a capital gains or losses. Unlike mutual funds, segregated funds do not distribute investment earnings to policyholder. The income is retained in the fund and the policyholder's adjusted cost basis and is adjusted to reflect the retained earnings. The policyholder is still taxed on the earning as though they had been paid out and received interest, dividends, or capital gains, and must be reported on their T3 slip by the insurer. Okay, dividends, interest, and capital gains distribution. Let's talk about this one. Unlike mutual funds, investors of segregated funds receive prorated investment returns. Returns are prorated based on the time an investor holds the unit in the funds during the year. For example, Massimo bought 1,000 units of XYZ segregated equity funds on June 1, and the fund declares a dividend distribution of a unit at the year end. Massimo's T3 will show an allocation of 3.33, reflecting that he owned the units for 7 of the 12 months, calculated as this. On the other hand, the income earned through mutual funds is not prorated based on the time held. For example, had Massimo bought a comparable mutual fund, his T3 from the fund would show as this, whether he bought it on January 1 to June or a day before the distribution was declared. Okay, let's talk about the treatment of capital losses. Any capital losses in segregated funds flows through to the contract holder and are reported on the contract holder state 3. This is unlike mutual funds where capital losses are used to offset capital gains within the fund. Capital losses not used in the present year can be carried forward or applied to losses in the past 3 years. Okay. Now, tax treatment on death benefits or maturity guarantees. Segregated funds typically provide a guarantee amount at maturity, generally 10 years, or at death. The contract holder is guaranteed a minimum 75% or 100% of the amount invested in the contract. The tax treatment applicable to these guarantees are ambiguous and uncertain. So therefore, the segregated funds information folder contains the position of the insurer regarding tax treatment. Let's talk about taxation of registered contracts. Um, well, when it comes to taxation of registered contract, there is no tax on income earned. For example, in terms of interest, capital gains and dividends in registered retirement savings plan RRSP and registered retirement income form RRIF or other registered contracts where money is withdrawn from these products, all funds are treated as taxable income. Of course, that's why they are referred to as tax deferred, right? Regarding registered education savings plan RESP, there are no tax consequences regarding the withdrawal of RESP contributions that were made with after tax income. All income in when withdrawn is taxable. So, and that brings us to the end of chapter 3. And we're going to move on to chapter 4. Chapter 4 is very, very small. Okay. Um, okay, let's wrap this up. Okay. Uh, this is not the taxation of life insurance. No, this is not the screen where I was. Okay, let me stop sharing one quick second. I think mm, is this jump because I'm on chapter 4. Chapter 4. Chapter 4, chapter 4, chapter 4, chapter 4, chapter 4. There we go. Okay. So now let me share my screen. Yeah. Okay. And I need to move this up here. Guys, bear with me, please. Okay, there we go. I think we got this now. So, yeah, we are in chapter 4. Okay, so we are making consistent progress. Now we are in chapter 4, the tax strategies using life insurance. This chapter examines tax strategies that are implemented using life insurance. These strategies are examined within four principal components. Number one, life insurance strategies used to offset or likely reduced taxes payable at death. Number two, taxable investment strategies implementing life insurance products for tax benefits. Number three, leveraging strategies and borrowing in terms of deductible incomes. And finally, donations, programs, and tax shelters. So now let's dive into this and let's talk about this estate planning. All right? For tax purposes, a person is considered to have sold all assets at fair market value on the date of death for the proceeds equal to the fair market value. This is known as deemed disposition of assets. Okay? If you have been following the class, you will notice that this is not our first time coming across this deemed disposition or assets being sold at fair market values prior to death or stuff like that. That is not new to us anymore. Okay. For someone who is married, it's what we call spousal rollover or common law partners. There are some exceptions to the deemed disposition and subsequent taxation of assets at death. Okay, certain assets such as RRSP can be rolled over to a surviving spouse without triggering a taxable event. Under the Income Tax Act, the taxation of the assets will be deferred until the funds are withdrawn or upon the death of the surviving spouse. And this tax deferral provision is known as spousal rollover. I said it right. What is this talking about? What is all this English that we have just read about estate planning? You see, every time I tell people that even dead people pay taxes, this is it. So that you guys know that we are not just trying to get people to know this is real, okay? So in Canada, when you are married or you have partners or common law partners or wherever, you see, CRA is a very patient dog, okay? So those assets that are owned jointly, between the spouses, the partners, and whatever, they will automatically roll over to the surviving spouse. Let me give you guys an example. You see, you have husband, wife, and then they have, let's say, 3 or 4 children, okay? Now, these spouse, they own a house, their own RRSP account, TFSA account, all the registered accounts you can think of, or any other assets, okay? Remember, we have said that there's what we call deemed disposition. Deemed disposition meaning that the CRA feels that all the assets individual have are deemed to have been sold at fair market price, so that you cannot come and say that a house that is worth 500,000 was sold for 50,000. No, it's not in your place to determine no how much it was sold. It will be deemed disposed at fair market price. But if this person is married, then all those assets will roll over to the surviving spouse. Okay. But when those assets will now be flowing over to the next generation, that is now going to the children, that's when the tax event will be triggered. Make sense? Okay. So let's move on to capital gains. Capital gains, capital gains. Well, life insurance can be a great tool for providing funds necessary to cover tax liabilities that arise upon death. That's right. Particularly when the objective is to maintain ownership of the assets within the family for the benefit of the survivors. You guys remember there was this example that we used a lot in I believe in chapter 8, 9, and 10, I believe. Becky and what's the name of the man again? The wife's name is Becky, the husband's name is whatever, right? In that example, we saw that the man wanted the cottage building to stay in the family, right? So you see, when we're doing this analysis chapters, so the man taking life insurance will provide the adequate fund for the children to pay the tax liabilities that will arise, you see, when the man dies, in order to keep the cottage within the family. Let's take a look at this example. Ralph and Melinda own a cottage that will be left to their daughter Martha, as stated in their wills. They purchased the cottage several decades ago and estimated that the tax on the taxable capital gain on the property would be around this X amount. You see, they purchased a second to die permanent life insurance policy to provide this amount to the estate. And the objective of this is to enable the estate to pay off the taxes. Okay? In example two, three brothers own equal shares in a successful landscaping company. They have an agreement in place whereby if one of the brothers should die, the surviving brothers will purchase the shares from the estate of the deceased, and their insurance agents arrange for it to buy insurance on the other lives in the amount of adequate to buy the shares. Okay. Again, this buy sell arrangement, we saw that earlier in the earlier chapters, right? Well, we were talking about key person insurance and buy sell agreements. Okay. So we move on to income tax payable on death or a registered plan owner. How does that work? Let's talk about that. An individual's largest financial assets are often a registered retirement income fund and an RRSP. So therefore, the fair market value of an RRIF, which is RIF, Registered Retirement Income Fund. By the way, Registered Retirement Income Fund is an extension of RRSP. Okay, so and we are going to see that in detail in segregated funds. Because after retirement, when contributions are no longer going into RRSP again, so this RRSP will be transferred into RRIF, where money can now start, when individual can now start withdrawing money from it. Okay. At the time of death, it's taxable as income in that year. Okay, life insurance is often used to pay taxes owing from the RIF, and thus leaving the beneficiaries with the full value of the RIF that is registered in the retirement income fund. Okay, let's take a look at this example. Ethel, who is a widow, turned 71 last year and rolled her RRSP into an RRIF, that is registered retirement income fund, at year end. Okay. So I think 71, the December of the year the person turned 71 is the last time they have to roll over the RRSP to RIF. But I'll confirm that, or better still, we'll see the exact date when we get it to sec fund section. Ethel wants to leave an estate for her children. Her major asset is her RIF, and she recognizes that when she dies, the market value of her RIF will be income for tax purposes, and a major portion of its value will be payable as income tax. So therefore, she also realizes that if she lives a long time, there will be very little value left in her RIF to provide an estate. If the value of her RIF was this amount at the time of death, all of it will be considered as income, and depending on her other income at the time of death, most, if not all, will be taxable income. So therefore, depending on the province in which she resides at the time of death, the tax owing could be as much as this. Therefore, Eagle's insurance agent determines that she can obtain this or term 100 insurance at an annual premium of this, and this will provide the funds required to pay the substantial taxes that will be owed after her death if she dies in the next few years. And if there is little residual value in her reef when she dies, then the insurance proceeds will provide funds for her children, Ethel, for her children. Ethel therefore decided to apply for this amount to cover the potential tax bill and funeral and other final expenses. Ethel decided that a life insurance policy will meet her specific needs to ensure an estate for her beneficiaries. So this is pretty much straightforward, right? And these are the things that this is such a great conversation, guys. But it's not easy. Okay, it's not easy. And sometimes we have to do it baby steps. Okay, so this is like the back end of this whole process. So for many of us, and because our home market now, for the most part, we are talking to first generation immigrants, including myself. So I find out that most of my conversations now is to even get people to take the first step first. Then we get to estate planning later, right, guys? Okay. Huh. Now let's talk about estate taxes and probate fees. Estate taxes and probate fees. Let's talk about that one. There are no estate taxes in Canada. And when a taxpayer dies, however, the deceased may face US estate taxes if any property was owned in the US. In such cases, it is advisable to work with a taxation expert knowledgeable about US tax law to determine US taxes owing, if any. Probate fees apply to mutual funds and savings instruments outside of Quebec. Probate fees do not apply to life insurance death benefit when beneficiaries are named. Insurance companies' investment products, that is annuities and seg funds. You see, all this boycott probate, and that is one of the advantages of what our segregated funds and annuities, that is only us that can provide these solutions. Banks cannot provide annuities or segregated funds. Every time when people ask me, okay, oh, why can't I buy my GIC? You can buy your GIC in the bank. But that your GIC in the bank or those investments in the banks are not creditor protected. And they do not bypass probates. You can see that here. Okay. Leveraging to make an investment. Let's move to that one. Leveraging to make an investment. Let's talk about that one. We are making progress, guys. Leverage is the term used to describe borrowing money for the purpose of investment. The concept is to increase investors' equity and thus profit above what it would be without the use of the borrowed funds. Both investors and agents should know that the investors are responsible for repaying the interest on the loan, as well as repaying the principal if the value of the investment diminishes. Interest on the loan is tax deductible. However, if the borrowed funds are used to contribute to RSP, then the interest is not tax deductible. Okay, this is very straightforward, guys. Agents should be familiar with leverage guidelines provided by the insurer whose product they sell and the mutual fund dealers guidelines pertaining to leverage if licensed to sell mutual funds. Okay? Many insurers are and mutual funds dealers place restrictions on using leverage programs for people who are near or in retirement. All right. Borrowing to contribute to a registered retirement savings plan. This is called RRSP loan. You see, we have what's called RRSP loan, TFSA loan. This is situation whereby people borrow money to contribute into these registered plans. And why do people do that? Especially for people that are in a very high tax bracket, right? Now we're coming to the end of the year. Maybe somebody earned like 150,000 and their tax, they pay almost 40% taxes. They are 40% tax bracket, right? So, and now the money is not there to contribute into their RRSP. So they can approach us and we arrange for them to get RRSP loan. So if they get RRSP loan, for example, they earn 150,000 and they're able to secure RRSP loan of 30,000. Okay. So if they put this $30,000 in their RRSP, see the significant difference. So if you take 30,000 times 40% of it, that's 12,000 right off the bat. So when they file their taxes, they are going to get 12,000 back in tax refund. So they can then give this 12,000 back to the company and thereby owe only what? 30 minus 12, that is 18,000. So instead of owing 30,000, now they are owing just 12,000. Meanwhile, their investment 30,000 will be growing for them, tax deferred, right? So this is what this is talking about, borrowing to contribute to a registered retirement savings plan. Okay, let's I've given you guys a summary of how it was. So going through this now will be making sense to you guys, I believe, right? One strategy for clients who do not have the cash to make an RRSP contribution is to borrow a portion or all the funds necessary to make that contribution. This strategy is usually implemented during the first 60 days of the calendar year prior to RRSP contribution deadline. Okay, I think our RSP contribution deadline, I think is March, is it March 30th? That's why they say the first 60 days, right, of the calendar year prior to the deadline in March. Therefore, the loan will be repaid by using the tax refund stemming from the contribution or from the take-home and income over the year. I say that, you see, that's why I said, okay, oh, you put in 30,000, you're getting your tax refund of 12,000. You can then put that 12,000 back into the loan, reducing the amount of money you are owing the bank. Okay, with this strategy, the interest paid on the borrowed fund is not tax deductible. Okay, your contribution is tax deductible, but the interest is not. Okay, borrowing to buy a non-registered investment. Let's talk about this one. Borrowing to buy a non-registered investment. Well, when a loan is taken out for investment purposes, the interest paid on the loan is generally tax deductible. When the investment is made in a non-registered account, provided the investment have the potential to generate income. Opening margin account with investment pillar is a strategy often used by investors to borrow against equity in their account with a set limit in place. The ratio of debt to equity must stay within defined limits. A decrease in the value of equity, that is the investment, will require the borrower to put up additional capital or sell enough assets to generate cash in the account to maintain the required ratio. Okay, so this is like imagine situation whereby if a bank borrows you, maybe the bank borrows you 20,000, okay, to buy an investment. Maybe the bank borrow you 20,000 and you are supposed to bring 5,000, right? Now, if the value of that investment goes down, so there's what we call debt service ratio, right? So that might drop or shift the line of that ratio that is supposed to be maintained, in a different direction, thereby leading to the bank asking you to put more money. All right. Interest on margin loan is also tax deductible, provided the loan is used to buy additional investment. Some agents recommend that their clients borrow money to buy segregated funds in rising market. Leveraging can make sense when the anticipated returns on investment is greater than the cost of borrowing. For example, a loan at 3% and an investment return of 8%. It makes sense to borrow money at 3% and use it to make an investment that gives you 8%, right? Uh-huh. So now we have an example here. Madeline paid zero interest on her investment loan. Her marginal tax rate is 46%. Consequently, she deducts this amount as a business expenses, reducing the tax payable by 46% by calculated as follows. Agents should resolve whether or not a leveraged investment strategy is appropriate for a particular client's needs. The appropriateness of such a strategy should be determined on an individual case-by-case basis in terms of apparent risk involved and also in terms of the cyclical and sometimes volatile nature of the market. Factors that should be considered when determining suitability are: does the client have the cash flow available to service the debt for an extended period of time if the investment declines? And is the client's tax bracket beneficial in terms of interest deductibility? Also, what is the client's risk tolerance in these whole situations? These are stuff that we need to evaluate before we make recommendation to leverage or borrow to invest to our clients. Okay? Agents need to keep in mind that in the past, interest rates have been higher than in the present. And while interest rates may be currently low, they can become higher in future years. Higher interest rate can altogether lessen or defeat the benefit of implementing a leverage strategy for the client. Ideally, investors should have accessible income to pay the interest or cover a potential margin call. Also, when borrowing to invest in segregated funds, agents should know that redeeming segregated funds units to pay interest lowers the maturity guarantees. That's very true. Okay, so let's move on to using insurance product for long-term income. How does that work? Let's talk about that. Prescribed annuities can provide for long-term. I hope I'm recording. Okay, yes. Prescribed annuities can provide for long-term income and be beneficial for a tax perspective because the original capital and interest are spread over fixed payments. Okay, an insured annuity is a combination of two products: life insurance and a life annuity. So, therefore, for risk-averse investors, this is often an alternative solution to guarantee investment certificates, VIC. All right. So, the prescribed annuity provides tax advantage income, and the life insurance provides a death benefit upon death. Let's take a look at this example. Fred, who is 70, recently sold his home and business and has this amount available for investment. He is unwilling to risk his capital and want to leave that amount to his children. He is aware he can earn 2.5% by purchasing a 5-year GIC, which should provide him with 500 annual income, all of which will be taxable. Fred's insurance agent suggests an alternative. He recommends that Fred apply for X amount of sorry, 10 to 100 life insurance, which will cost him this amount per year. And once that is approved, Fred can buy a prescribed life annuity for X amount, which will provide him with annual income of this, with a taxable portion of this. Therefore, the annuity payment less the cost of insurance will leave him with this amount, which far exceeds the 500 income from GIC. Moreover, only this amount of the annuity income is taxable compared with all of the 500 that will be taxable with respect to GIC income. Therefore, Fred's major risk is that interest rate will rise in the coming year and he will not benefit from any rate increase. So let's talk about charitable donations. So this one we just talked about what? Using insurance product for long-term income. How you can use insurance product to be receiving income. Again, this is just a brief forever. Don't worry yourself. I know why the reason why I'm not diving deeper into this is because we are going to see this in flesh, in details, I mean, under the segregated fund modules, okay? So you don't need to worry too much about it. But let's take a quick look at charitable donations, okay? Registered charities often take out insurance policies donations from their supporters. Donors to registered charities receive a federal and provincial charitable donation tax credit, okay? The donors will be the life insured and the organization will be the policy holder and beneficiary of the policy. Let's take the donor will be the life insured and the organization will be the policy holder and the beneficiary of the policy. As long as the premiums continue to be paid, the organization will receive the death benefit upon the death of the life insured. Okay? For the donor, the federal charitable tax credit is 15% on the first this amount and 33% on any other amount more than this. So therefore, the 33% credit applies if the individual income falls within the highest range of the marginal tax rate. The provincial tax credit rate differs in each province, and these tax credits are non-refundable. Don't tell me about Quebec. Don't care about Quebec. For donations made after March 2013, qualifying first-time donors may receive an additional federal tax credit of 25% on the first amount monetary donations. An individual may claim a tax credit for a donation up to 75% of the net income. The donation limit is 100% of the net income in the year of death. Any unused amount can be carried back to the year prior to the year of death, and the donations limit will be up to 100% of the income in that year. All right, move on to assigning a new insurance policy to a charity. How does that work? Let's talk about it. A common strategy is to purchase a life insurance policy to provide a charitable donation to a registered charity upon death. To be entitled to a charitable tax credit for the premium paid on the life insurance policy, the policy must be assigned so that the charity is the holder and the beneficiary of the life insurance policy. For example, Rivka has been donating this amount annually to the alumni fund of the university she attended and received a tax credit receipt for that amount each year. A representative of the university suggests that she considered buying a life insurance policy and assigned it to the university. She agreed and purchased a Term 100 life policy with an annual premium of this and a face amount of this. She assigned the policy to the university and continued to pay the premium, for which the university issued a charitable donation tax credit receipt equal to the premium. Assuming Riska does not let the policy lapse, the insurance policy will be paid to the university when she dies. Hmm. Wow. Ah, we're almost there, guys. We're almost there. Oh my God. Moving on to. Oh boy. Assigning an existing policy to a charity. We just looked at assigning a new insurance policy to a charity. But this time around, what if it's an existing policy? How does that work? Another common strategy is to donate an existing policy to a registered charity. In such cases, the charity will issue a charitable donation tax credit receipt for the cash surrender value of the policy. Additional tax receipt will also be issued any additional premium paid by the donor. Note that if the policy cash surrender value exceeds the policy adjusted cost basis, therefore the policy gain will be taxable as income in the year the policy was donated to the registered charity. For example, Lars has a permanent life insurance policy he no longer needs. The market value of the policy is this. He calls the fundraising office at his local hospital and speaks with the director, who informs him that he assigns the policy to the hospital. He will receive a tax credit receipt for the market value. Furthermore, if he continues to pay the premium, he will receive a tax credit receipt for this. Okay? Naming a charity as a beneficiary. You see, these are different ways that we assign or donate to charity organization. Okay, we can assign a brand new policy, we can assign an existing policy, and then we can also name the charity as a beneficiary. In the case where we name the charity as a beneficiary, another less effective strategy is for the life insurance policy holder to name a charity as a beneficiary of the policy. Okay, this strategy is less effective. Let's see why. This is not as tax efficient as the charity does not own the policy and therefore cannot issue receipt for the cash surrender value or premium paid. Okay, I see why. You guys to see you see why, right? And you see why giving is so encouraged in this part of the world, right? Because you see, this may not make sense to you. You see, if you're starting out, you are still building, but it gets to a point where you start making this money, all these things, all these tax strategies start making sense to you guys. Why do you think that all these Kardashians are buying private jets? They're not buying private jets because, you know, yes, they have the money, but do you know that those private jets are tax deductible to their business, right? So let's say that the taxes they're supposed to pay in 1 year is 100 million. They'll go buy one private jet, 75 million. They have reduced that tax from 100 million to 25 million. Then they will now look for other avenue again. Remember, I told you guys, is tax evasion is criminal, but legitimate tax avoidance using tax strategy to reduce how much tax you pay is not illegal, right? So there's a level you get to, all these things start making sense because you either give it, you when you give, you get the tax benefit. If you don't give it, CRA will still collect it anyways, right? So, however, the charity will issue a donation receipt for the death benefit received to the deceased estate. All right. So now let's move on to donating a segregated fund contract. How does that work? Donating a seg fund contract. Well, special rules apply when publicly traded securities and insurance contracts holding segregated funds are donated to a registered charity. In normal circumstances, upon the disposition of the security, 50% of a capital gain is taxable. However, when security or segregated funds are donated to a registered charity, the capital gain inclusion rate is reduced to zero so that none of the capital gain is taxable. Really? Aww. Let's take a look at the example. Jack redeemed this amount of segregated funds that have an adjusted cost basis of this amount. He donates the money to a registered charity and receives a charitable tax credit receipt for this amount. He pays taxes on half his capital gain. Jill, on the other hand, donates her this amount of seg funds contract to registered charity while her adjusted cost basis also is this. Her capital gain inclusion rate for the donation is zero. So she pays no tax on the capital gain and receives a charitable tax credit receipt for this amount. Wow. For more information on segregated funds, consult Manulife financial page, charitable giving at this and this. All right. So let's take a look at donation program tax shelters. Donation program tax shelters. Well, donation program tax shelters are tax shelters and donation plans that offers unusual high returns, tax refunds, or tax reductions in excess of the amount actually invested. Therefore, the following is an example of what a tax shelter arrangement involving a charitable donation receipt looks like. A promoter sells a tax shelter like arrangement to individual taxpayers involving 10,000 pieces of art. Each taxpayer acquires one piece of art for its fair market value of zero. And the valuator is aware of this information but agrees to appraise each art piece at this amount. Currently, the promoter solicits a registered charity that agrees to accept the art as a charitable donation and issue a charitable donation receipt of the appraised value. And this charity immediately auctions off the art to the highest bidder, and the price paid reflects the zero value per piece. A tax return specialist without any direct knowledge of the false statement prepares the income tax return of the client, the purpose piece of what am I reading? Let me take that again. A tax return specialist without any direct knowledge of the false statement prepares the income tax return of a client who purchased a piece of art and donates it under this arrangement. The CRA reviews the client returns and determines that it contains a false statement. The overvaluation of the property donated And since the 1990, the Canada Revenue Agency has continuously issued warning about donation program tax shelters. In almost all cases, the tax donation credit issue for the donation will be disallowed, sometimes even retroactively by the CRA. Advisors should proceed with a high degree of caution, as many of such programs are offside with the CRA and could lead to trouble for both the advisor and the client. Agents should review the CRA documents on donation tax shelter scheme, in particular the CRA publications, Canada, blah, 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 blah. Agent needs to know their employer policies and consequences regarding participating in these unauthorized activities. Hmm. Wow, this is straightforward. Donation program tax shelters. What they're telling us is just to be careful. I've encountered, this type of thing before. They'll tell you, you went for an event and they're just talking about all these things. If you're not careful, you land yourself in a situation whereby there will be massive audit from CRA on your account. So don't even go there. All right. And that brings us to the end of chapter 4 of taxation principles. I told you guys, we made it. Woo. Thank you guys for sticking around. And yeah, I'm super happy. We've completed the first module successfully. And according to schedule, today is November 12th. If you guys go back to the schedule I published in the Telegram group, we are on schedule. Super happy. Okay. And I'm going to try my best to ensure that I download the recording and publish it for you guys latest by tomorrow morning. All right. Again, like I said this morning, you guys have now till Saturday to write your certification. So make sure you catch up on all the videos. Do your chapter by chapter quizzes, please, guys, and write your certification before we resume sec funds on Saturday. Thank you very much and have a great week. Happy
You
Remembrance Day,
too.
guys.
Thank
Bye-bye.
you. Thank you. Thank you. Bye.
Yeah.